I'm going to go over a few exercises out of the revenue chapter, the ones that I think are just a little bit more unique in how we record the revenue. So this one we have Video Planet is selling a TV package. So it comes with the TV, a remote, and on-site installation. So the installation includes programming the remote and setting it up with their entertainment systems. And they are all three separate performance obligations. So they would sell the TV if it was separately. The TV would be $1,700. The remote would be $100, and the installation would be $200. So in total, it would be $2,000. However, they're running a deal for $1,900. Oh, sorry about that. So then if I go in here and say, okay, we're going to allocate that $1,900. So what I'm going to do is I'm going to take this each component, so the $1,700, and I'm going to divide it by the $2,000 total, and that's going to give me a percent. And then I'm going to actually just drag this down so it does it the rest of that. Oops, didn't work. Sorry. Oh, because I gotta lock in. Quick, and then we'll drag it down. Okay, so then the TV is going to be worth 85%, the remote is worth 5%, and the installation is worth 10% of the price. So then we'll come in here and say, okay, we're offering a package deal of $1,900. So then if we take the $1,900 times that percentage, we're going to allocate it to the TV at $1,615. And then if we take the 5% and we multiply that by the price, then the remote is going to be $95. And then if we take, again, the 10% and we multiply that by the price, the package price, the installation is going to be $190. So then that's how we would break it apart. So again, we go to what its purchase alone price is, come up with the total, figure out what percent each component is of that total, and then apply those percentages to the package price. Okay. Then if we come to this one, I might need a little more space. I'll start over to the side though. So we have this Rocky Guide service, and they are offering day hiking tours throughout the Rocky Mountains, and they receive $1,000 a day shortly after the end of each month. So Rocky learns that they could receive a $100 bonus per tour day if their previous month's service was excellent by the customers, rated excellent. So the $1,000 a day and any bonuses are going to be paid in one lump payment shortly after the end of the month. So on July 1st, based on prior experience, Rocky estimates that there's really only a 30% chance that they're going to be scored excellent by their customers. So since it's only a 30% chance, they are not going to record that bonus as being received. So our first thing says, prepare their journal entry to record the revenue given July 1st through July 15th. So I'll just kind of try to squeeze it in over here. So on July 15th, they're going to set up a receivable because, again, they're not going to get paid till the one lump sum at the end or at the beginning of the next month. So that receivable is going to be for the 15 days at $1,000 a day, so $15,000. And then they're going to record their revenue. So let's see, do they give us a name of what they would like it to be called? I don't see any references to, so we'll just call it service revenue. Then we go down to the 16th. Now, then the next day, July 16th, they got some excellent service reviews for the first part of the month. So they're like, okay, hey, now I think we got an 80% chance of getting it. So then those remaining 15 days, or is it 16 days? the remaining, because there's 31 days in July and we recorded 15. So the remaining 16 days, they are thinking, I think we're going to get this. I think we're going to get this bonus. So then let's go down and say, then on the 31st, what are they going to record? So then they're going to set up an accounts receivable for the 15 days times the $1,000, but then also the extra $100. So for 16,500. And then they would have service revenue for 15,000, the $1,000 a day, and then they would have bonus revenue. Or sorry, it's 16,000. I do 15 days up here too. Yeah, sorry, let me go back. I think it'd be 16 just because there's 31 days in July. Okay, so 16 days, and then, so 16 days, and then 16 days of the bonus. But then on August 5th, they learn the unfortunate news that they did not get awarded excellent evaluations. So then they're not going to receive the bonus. So then the cash is going to come in for the 31,000 for the 31 days. And then we're going to take that out of the accounts receivable. Then that bonus, we're going to have to reverse it. So then we're going to debit the bonus revenue, and then we're going to credit the accounts receivable. So then we reversed it. So at the time we recorded it, we thought that there was an 80% chance we'd get it. So that's why we recorded it. But then when the truth comes in and we realize, hey, we're not going to get it, then we have to reverse it and take it off of our books. Okay, then this one is also a long one. I don't know. I probably am going to have to go down, up and down with it. So we have the long-term contract and how do we get to record revenue? So they give us the details. It's a contract for $2 million that crosses over 2024 and 2025. They give us the cost incurred in 2024, what they estimate it would be at that point in time to finish it. As we see, they ended up spending more than that. They billed out 380,000 in 2024, and then the balance in 2025. They collected 25,000, and then the balance in 2025. So the first thing it asks is compute the amount of revenue and gross profit to be recognized. So maybe I can do that over to the side. I think maybe I can. Okay. So if we come here and say, okay, we'll start with our profit or our revenue. 2024 and 2025. So we have $2 million of a contract that we're doing. So we want to figure out in 2024 at what level are we completed. So we take the 300,000 and then we divide it by the 1,500,000. Right, so where did I get that though? If we go back to the problem, and I don't want it to come over. Okay, we have $300,000 of costs incurred, and at that moment we estimate another 1,200. So then that's where the 1,500 is coming in. Add those two together, and then 300,000 divided by the 1,500 gives us 20%. So then we would take the 20% for the 2 million. And then we are going to multiply those together. So that times that is going to be our revenue. Did I not? That doesn't look correct. So 2 million times the 0.2. That looks better. I don't know what I just did in that formula. Okay, so $400,000 is what is going to come in as revenue, or what they're going to record as revenue. Then the remainder of the 2 million, so 1,600,000, is going to go out until the following year. So again, in total, we want to make sure we've accounted for the whole 2 million. So we did. Okay, then our gross profit is going to be based on what revenue we have. So our revenue that we are recording is the 200,000 in 2024, the 1,600,000 in 2025, then less our costs. So in 2024, again, looking back at the table, our costs are 300,000. I'm going to be losing money there. So then if I sum those, I have $100,000 of gross profit. Now then, again, looking back to the table, the costs in 2025 were $1,575. So then we subtract those out, and then we have $25,000 in our gross profit. Then number two, so that's number one. Then number two says, now compute the amount if it doesn't qualify for revenue recognition over time. So then in that case, in 2024, we're not going to record any revenue. So the only way we record the revenue in 2024 is if we're using that percentage of completion. So then we would have all the 2 million go out into 2025. And then again, we're not going to match up any costs in 2024. They would just be hung up in our on our balance sheet. So then the 1,575, or the 1,575,000, all those costs would just come against it and be entered into our income statement when the contract is completed. So then, no, that's not right. Did I put in too many? I'm gonna, whoops. Let me add my zeros just so I can see. I feel like I'm missing something in there. Oh, I know, because it's not, sorry, I'm missing that 300,000. So these are our costs incurred during the period. So in total, it's 300,000 plus the 1,575. So 125,000. So again, going back up here, it's the same. It's the same as what we did using the percentage of completion. We just did it over the years up there based on when we earned it. But then in total, we're still recognizing the same gross profit. Okay, then we'll come down below for the third one. So then number 3 says prepare the partial balance sheet to show how the information related to this contract would be presented at the end of 2024, assuming that they're recognizing the revenue over time according to the percentage of completion method. So we would have accounts receivable based on what we billed them. So this is 2024. So if we go back up to the table, we billed them 380,000, and they paid us 250,000. So that would leave 130,000 that they owe us again at the end of 2024. And then we would have the CIP, which stands for the construction in progress. And then we would say, okay, we billed them the 400,000. So that would go into the construction in progress. Or I mean, sorry, we didn't bill them. We recorded the 400,000 in income, and that would go into the construction in progress. And then it would be offset by the amount that we billed them. So then that would leave 20,000. So again, the amount of the revenue that we recorded less the amount that we billed them for those services. Okay, then let's see. Then number 4 says, this is number 3. Then number 4 says, prepare the partial balance to show how the information related to the contract would be presented at the end of 2024. I think, and darn it, I cut the last part of that off, but I think that that was asking for if we did not have the same thing as what we did if we did not qualify for recognizing the revenue over time. So then we'd have the accounts receivable. Same thing as above, though, because that's happening whether we're recording the revenue or not. We're billing them progress billings as the job goes on, and they're paying us. So that part would be the same. So it would still be the 380,000 minus the 250,000 that they paid. But then now down in our liability section, we would have a billings, and then that billings would be the 380,000 that we billed less the $300,000 of costs that we incurred. So the 380 less the 300, because again, we're not offsetting anything. We collected more than we actually paid out. So we have to show it as a liability until that job is done. So that would be how those are recorded. And hopefully maybe that helps a little bit with like the journal entries as well. I do think in some cases you'll have to not only just map these dollar amounts out, but do the journal entries so you know what accounts they are hitting. But when we bill them, it's going to be our accounts receivable, and then the construction in progress if we're doing it progress billings or progress reporting over time. And then if we were doing if we couldn't record it till the end, then we would be debiting the accounts receivable and crediting this billings account. Okay, so that is not all of the special examples, but it gives you a little flavor of each one. So hopefully that helps.